Good afternoon, and welcome to UOB's Start of Year webinar organized by our Global Markets team. I'm Patricia Tan from UOB Global Market Sales, and I will be your host today. This time, we are streaming live from a studio. We certainly look forward to an interactive and exciting session together to kickstart the year 2022. For our agenda today, we shall start with the 2022 Economic Outlook by Teck Hin. This year, will we see economic rebound globally and in Asia, taking into account the Omicron impact and the inflation risk? Teck Hin will share with us shortly his views and insights. Next, we have two fireside chats lined up for you too. First is the sharing by UOB thought leaders on sustainability and asset tokenization, on how UOB can help our clients participate in this fast-growing development. Next, our market strategists will identify foreign exchange and interest rate trends, and they will be joined by Eileen Chia, Group Head of Global Market Sales. Together, we hope to provide the potential issues that concerns our clients and what they are doing about it. There will be a Q&A session after each fireside chat. Do submit your questions by following these steps. First, on the bottom right corner, you will see a Q&A panel. Click to expand it. Second, select all panelists. And finally, just type in your questions and press enter. And there you go, your questions will be sent directly to our panelists. Let us now start off the event with the 2022 Economic Outlook that will be presented by Mr. Swan Teck Hin, our Head of Research. He is responsible for macroeconomic and foreign exchange research with a primary focus on Asia. He presents the team's markets views regularly to the media and clients too, so you might find him familiar. You might actually recognize him because of his frequent appearance on TV. Now, without further ado, I will hand over the time to Teck Hin. Teck Hin, please.
Thank you, Patricia. Good afternoon, everyone. Really happy to have everyone here joining us, our Global Markets event today. This afternoon, we will have an exciting lineup of event like what Patricia mentioned just now. So for now, I will just share with you over the next 30 minutes or so, the key themes and opportunities and also things to watch out for this year that I think companies and also even individuals should take into account in their investments, in their business operations. Okay, so there are a few things that I would like to share here. In terms of inflation and Fed, I think these are the key topics of the day, and then we should really pay close attention to that. And then burning questions on ASEAN and also China that happen all the time, and I'd like to address some of the key risks that we should watch out for China and how should we think about that risk. And finally, for those who are in Singapore, I think there are three rates that we need to think about in Singapore. One is, of course, interest rate. What should we do about it? And then second one is inflation rate, right, in terms of cost to business. And finally, the GST rate. So these are the rates that I'll be talking about for the Singapore segment. Okay, for the first segment on inflation, Fed, and also China, let's take a look at, let's get this COVID-19 out of the way first in terms of the Omicron. All right, for Omicron, I think quite a bit of worries when it first started in November, late November, when it first popped up, and I think a lot of people are worried. Were worried, what should we do? Is it going to be very bad? How bad is it going to get? So at that time, our team got together and came up with this scenario for for the Omicron, right? And then we decided at that point that this Omicron, yes, is a risk that we need to watch, but we don't want to be overly pessimistic about it. So in the end, we came up with this scenario for Omicron as in the traffic light system, being in the amber situation. Amber situation for Omicron, which is, well, there's downside risk that we need to watch, but overall, I think we should be okay. Okay, then the more pessimistic one is that, of course, a red traffic light. But why is it in an amber situation? The very important thing is the vaccine at the time, people are not sure whether it will be working against Omicron or not. Then we found out as we go along, we find out that vaccine actually work quite well against Omicron. As long as vaccine can work well, as long as hospitalization rates are manageable, the death rates are manageable, then we should be okay in this amber situation where we have BAU, business as usual, with some adjustments that we need to make. So there was a time, at that time, we thought about this Omicron and how we frame our thinking around this. So if Omicron was so powerful that the vaccination could not work and then we had to restart, what would happen? Then it will be back, it will be in the red situation, red traffic light, where we go back to early 2021, when the Delta first hit and vaccination wasn't so prevalent yet in terms of the rate, in terms of the scale of our vaccination. So here we are, the numbers and also the reports that we see so far, I think justify our amber situation. Okay, so that's what we have right now, a bit of BAU, going forward, some adjustments, maybe some downside risk. All right, but we don't want to be overly optimistic and say that at the end of the world, we have to go into the red situation and back to lockdowns and all that. Okay, so here it is. We have the three scenarios. But one thing you'll note, somewhere in the middle of these three scenarios, somewhere in the middle of the chart, we talk about inflation. Right? Under these three scenarios, take a look at the inflation situation. Is still going to have upside pressure on inflation. Right? Whether you're green, whether you're amber. And that's a common thread around it. And in the red situation where things get really bad, inflation risk could actually be higher, right, because of the disruptions. So inflation is one thing, and that's my next topic is about inflation and then the implications on Fed interest rates and also the local interest rates that we need to watch. Okay, so here it is. Inflation is one thing that we watch, and I just want to show you quickly on US inflation figure since 1984, the highest over the past few decades, 6.9% for November. And tonight, you'll receive the December US CPI report, and then you'll find out, is it going to be above 7%, and how much is it going to be above 7%? And what are the causes, what are the components that are driving the inflation rate? You can see that on the screen here, basically all the components are driving inflation higher since somewhere in middle of 2021, right? All the components, the transportation, the rentals, even apparels and food, F&B, and all these components driving up the overall headline figure. When the central bank look at these headline figures, they would have to do something, right? They have to react using their policy, whatever it is that they have to deal with this situation. They cannot just say that, oh, well, my policy tool cannot really address a supply side issue, so I'll just leave it there. No, they cannot do that. So they have to react to this inflation. But first, let's get through to what are the major causes for this inflation suddenly jumping up. Okay, three causes that I can think of, three causes that we come up with. One is basically the logistics issue, the logistics supply chain disruptions that we have been seeing for the past 1 year or so and filtering through to 2022 as well. For example, just a quick one, shipping costs. Shipping costs out from China have improved slightly on the screen here, on the chart, improved slightly, but still we are talking about double-digit year-on-year increase for most of the places. Right? Even in Europe, it's actually triple-digit increase year-on-year. Shipping costs very expensive, and that goes into your cost of production as well and cost of selling. Okay, simple as that. And then once the ship arrives at the port, then another logistics problem for those port operators in the US and possibly in Europe as well. The port workers cannot unload the container boxes fast enough. So if you have that situation, for instance, in this case here, for Port of LA, in this picture here, 18,000 boxes they can handle a day. But they have 500 over 1,000 boxes waiting at the port. And there are new ones that arrive as well. So this logistics issue can resolve itself, but it will take some time. And meanwhile, the numbers for the inflation will just continue to move higher or even stay at a high level. So logistics issue, need to deal with that. And why is that you have this logistics problem? The other one is, of course, some of the workers, if they get sick, they cannot go to work, right? So the labor issue as well. They're facing labor supply issue in many, many places, not just in the US, they are in Canada, Europe, and Asia as well. So you hear about shortages of labor in For example, in Malaysia, the palm oil seeds, the palm oil fruits just fall on the ground because they don't have enough workers to harvest the fruits, and they just rot on the ground. Right? So you have stories like this, you have situations like this that cause a problem in your production, in your delivery, in your selling as well, right? So you have a labor market issue, and then you cannot get your goods fast enough to your consumers. When you cannot get your good fast enough to consumers, prices will have to reflect that as well. Okay, so logistics, and then labor market issues, and then of course the last one is more familiar to many of you, is the commodity prices themselves have already gone up quite significantly. You have the gas prices, going up quite significantly. Used to be about below $2.50, and it's gone up to as much as $6 per unit of the natural gas. And of course, soft commodities as well. And crude oil prices, for example, now it's $80 over dollars. Maybe last year, we were talking about $50, $60. So at the oil pump, when you pump petrol for your car, then you can fuel it quite directly. Unless you drive an EV, then you don't have a problem, right? You don't have to worry about your crude oil prices, which sustainability topic will be discussed later in a later panel. Okay. So anyway, so all this inflation issue, is it just US? Although I use US as an example, no, it's not. It's actually a global issue. Take a look at the chart here, where the diamonds, the blue diamonds, are the central bank's target for my inflation for this particular country, for this particular area. The red ones are the average inflation rate since 2021 January. So as you can see, at the bottom, you see the difference. Singapore, on the right-hand side, anything that left of Singapore, the local inflation rates have already more than exceeded central bank targets. So when you're more than exceeded central bank targets, what do? Central banks would have to act, and some of them have already done so. For example, Bank of England, Bank of Korea, and many other, quite a number of central banks have already reacted to that, right? Pressured by higher inflation. So, and Singapore has already done that as well. Back in October, through the Sing Dollar NER policy slope, right? So this is the kind of a reaction the central banks have to do, and of course, the U.S. Federal Reserve would have to address that issue as well, right? We have to address the issue, and what we are looking at for this year, for the U.S. Federal Reserve, is our house view is for 3 rate hikes from the U.S. Federal Reserve. We will start in June, 25 basis point, and then go on to second half of the year, another 2 times of 25 basis point, 0.75. By end of the year, it will be at 1% for the Fed funds rate, right? So that's our current house view. But of course, in the recent market actions, last night, Jerome Powell talked about doing more in terms of controlling inflation, managing inflation, so through interest rate. So now the market is talking about maybe 4 times of rate hikes. So this is what we have right now, about 3 times. So that means there's upside potential for interest rate, upside potential for the US rate, and therefore it will translate to, in Singapore and other parts of the world as well, higher interest rate ahead of for this year. So we do have to manage that, and our colleagues here will be able to answer some of these questions later in the panel about interest rate outlook. Okay, so one question I want to address now about this inflation is that, would it cause some kind of stagflation in, let's say, in the US, right? Because of high inflation, and then you have the interest rate going up, could it cause a recession? Let's take a look at this, the slide here on the screen, where you can see the average length of the US expansion cycle. The average length in the middle, the mean 1960 to 2020 is about 43 months. So that means after 43 months, there's a recession, right? 43 months on average. But here, where we are right now is at the bottom, at the post-pandemic line. We are at about 22 months right now in the business cycle. So assuming that we have an average expansion cycle here this time around, average. So that means we should still have another 20 months or so to go, and another 1 to 2 years to go for the business expansion cycle in the US. Okay, so unless bad things happen along the way, but if it's normal, if it's managed well, the central bank handles the rate hikes in a measured manner. No surprises there. No surprises from the COVID-19 situation. I think we should be able to hit at least on the average 40 over months of expansion cycle. So there's still some room to go. What's the longest expansion cycle in the US? At the top of the screen, 128 months. Right? So about 10 years of the cycle before hitting a recession. So if you're lucky, we could even get that, a long expansion. So as long as the US expansion cycle is intact, and that will benefit places like Singapore and also the rest of the world as well. All right, so the stagflation is always a risk there, but I would not place too much probability on that part of the stagflation being the main scenario that we are facing. All right, so here it is, interest rate going up, and what would happen to our Singapore interest rate then? Okay, let's take a look at, okay, for the Singapore interest rate, I think my colleagues later will address that issue. For the SIBOR, the 3-month SIBOR, 3-month SOR, and all those, by end of the year, we should be heading towards the 1% mark. Okay, so what should we do about it for companies? How should we manage this? Higher interest rates are coming, potentially even higher. Although on the screen here, what you are seeing is that our business expansion in Singapore, in around the world, I think should be a modest, moderately, quite a good year for 2022 as well. Okay, so the steady expansion, for example, for Singapore, after the 7.2% growth last year, I think this year we should be able to look at about 3.5%. For China, somewhere later I'll talk about China, 7.9% expectation, close to 8% for 2022, about 5% or so. I think even at the 5%, I think should be quite decent because the size of the Chinese economy has grown larger, right? So it's off of a bigger base. So we should be quite comfortable, even with a 5% expansion for China. So as long as these big economies are moving along, that should benefit places like Singapore and ASEAN. But we do have to keep an eye on our interest rate. So very important. Okay. All right. Let's take a look at China. I think China won't. I think there's always interesting questions coming out about China, and people want to know how is it going to perform this year. I think overall this year, I think should be another just a moderately expansion year, moderate expansion, 5%, 7.98% last year. So here, disappointed in the third quarter with only 4.9% growth, right? Because of some of their own issues within China itself. For example, electricity rationing that they have, and also some logistics issue as well in China. So that caused a bit of a slowdown. And then going to this year, first quarter, I think we should be expecting about some recovery into the first quarter, and then for the rest of the year as well into the 5% sort of range. Again, we still have to remember these numbers are off of a bigger base, right? It's a much bigger base, 100 over trillion RMB in China in terms of the size, second largest in the world. So we should not be expecting, another double digit. Why not another double digit growth for China? Because the base is much larger already. Okay, so that's something that we have to keep in mind. But I do want to address one issue on the risk. People talk about, the debt in China, very significant debt. How should we think about it? Is it going to pose a downside risk? This topic comes up every year, right? Leverage in China, high debt load, is it going to cause problem? Is it going to cause a collapse in the Chinese economy? And then that's the end of everything. Well, take a look at this Chinese debt. Indeed, it has grown much larger. From 2008, after Lehman Brothers crisis, the $1 trillion of stimulus caused the debt load coming from 140% of GDP at the bottom, 139%, 140%. Today, we are looking at about 280 over percent, 260% or so in terms of GDP, the total debt load. So within the total debt load, that's all the debt. Owed by who? Owed by the government, owed by the households, owed by corporates. Take a look at the screen on top, at the top part of the chart, where the dark blue color is a government debt. Government debt consists about 67% of GDP. So that's a local government, central government debt. And then the red part, 61% is household, owned by the household mortgages, car loans, personal loans, and things like that. At the top part, that's where the heavyweight is, corporate debt, 160% of GDP, 1.6 times of GDP. Okay, so 1.6 times of GDP. How do we think about it? Where is SOE in all this? Is it all owned by the private sector? Well, there's no clarity on how much is owed by private sector or SOE. But IMF did a study about 2-3 years ago. Estimate roughly about this corporate debt, about half of it is owed by SOE, state-owned enterprises, government companies. Okay, then the other half is by the private sector. So 80% of GDP. So why do we want to know about this? Because if it's owned by SOE, so the chances are if something bad happens, the government will have to step in to do something. Right? Government will have to step in to do something. Then the question is, do they want to do it? Can they do it? Right? Can the government do it? Governments have the capacity or the bandwidth to manage the debt? So if you can see that the government debt load is about 67%, right? And the corporate debt, let's say 80%, so SOE, more or less, we don't have to worry. So we worry about the other part, the private sector, about 80%. So the Evergrande story comes out, right? Along this story, the Evergrande story, is it going to cause a systemic issue in China, default? Out of that top blue part, the Evergrande total debt, right, is around about 3% of GDP. So of the 160%, so Evergrande figure about 3% down there, 3% GDP. So it's huge, large for one company, but overall scheme of things, they contribute to that 3% point. So you have, of course, other property companies as well. So in terms of triggering a systemic risk, right? Triggering a systemic risk, I think the government is able and willing to prevent a systemic issue from developing, right? They would have to step in to prevent that from happening. So they are managing it now, so I don't see that kind of risk. And whether they have the capacity or not, take a look at the comparison across. Comparison across different countries. China, right in the middle, 280% or so. And next to it is Japan. Japan, JN, is supposed to be JP, I think more appropriate. But anyway, Japan, you can see that it's 400% of GDP, 4 times of GDP. And UK, US on the right-hand side of China, the total debt load in terms of the scale is roughly equivalent. Just that the component, the mixtures are different. And then you focus on the blue part. The blue part where China government debt is about 67% of GDP. You look across to the neighbor, Japan is 200%, 2 times of GDP. And UK, US, for comparison, is about 100%. So in times of trouble, the government has to step in. Where do they find the leverage? Do they have the capacity to leverage up further? And clearly, I think for China, there's room for it to leverage to prevent things from getting even worse. Right? So there's room for China to move. If you want to worry, I think you should worry about Japan. It's already 200% of GDP for government. If things really bad or continue to be not so good, I think the leverage is going to be more and more difficult for the Japanese government to continue. All right, so this is the kind of picture to address the risk on China. So I won't lose sleep on this part. Yes, this is large. We need to pay attention. But is it the end of the world at this point? I don't think it's the end of the world. I don't think we are anywhere near end of the world for China, because there's room for the government to manage the situation. Okay, so last bit on this is on ASEAN. Okay, what I say just now, you may not agree. Why not we look at how the market is looking at the situation? How do they assess the situation in China? One is look through from the bond markets, bondholders' point of view. The bondholders, the red part is your Chinese government bond yield, and then the other one, the blue one, is treasury yield. You can see that the bondholders relatively confident about China. So there's no massive selling going on here. The bond yields holding steady for these Chinese government bond yields. How about the FX market? Well, the FX market, the investors there equally, I think, confident at least, right, or sanguine about what they are looking at China. So you can see the lines are going down. That means appreciation of the currency, appreciation of the Chinese currency. So far, I think they are quite comfortable with it. Despite all this turbulence in your property market sector in China and also other worries about China. So far, I think it's still manageable, still confident in their outlook in that sense. Otherwise, you will see some selling off. Okay, so the last bit on this segment is on ASEAN. So ASEAN itself, we're also going to see some rebound. We're already seeing some rebound, for example, in Vietnam, after they get through from the Delta lockdown, and the situation, I think, continue to improve. One important thing is vaccination rates have gone up quite significantly for most of our ASEAN neighbors. I think Vietnam is already at 50% and Malaysia 80% or so, 70-80%. So the vaccination rates have really caught up, and that would prevent, or that would actually reduce the risk of this COVID-19 giving us trouble in this space. Okay. So what is driving this ASEAN growth? One of the important things is on the left-hand side is your PMI. You can see PMI all above 50. And then on the right-hand side is your exports, your trade, external trade. That's the other driving factor, right? As long as the demand from China, demand from US, Europe holding steady, improving, or even holding steady, that would help all these export-oriented economies in Asia, including our ASEAN countries and Singapore as well. So you can see the chart has been zooming up. On the line on the right-hand side, have been zooming up. The exports have been performing very well to cater to the demand overseas. Cater demand in the US, China, and elsewhere. Right? So that's a very important picture that we have. And I think as long as the expansion, as mentioned earlier, as long as the expansion is there, it should be able to continue to perform. All right? And then the other thing, one last thing on ASEAN is that the foreign investors, foreign direct investors, investment investors, the inflows are continuing. The chart on the left-hand side will show you FDI inflows continuing to be very strong in ASEAN in 2021. That's November, December numbers. 144 billion in total compared to 100 billion a year ago. That is in 2020. So that is a kind of a confidence that people are showing. Investing directly, their factories, their businesses in ASEAN. And of course, the bulk of it is into Singapore. But again, Singapore is a platform, a springboard for many of these ASEAN countries. So some of these direct flows are going, some of the flows are going into our neighbors in these in the ASEAN countries. So if you look at other, for example, in Malaysia, very strong confidence, right? After the punishment in 2020 from the pandemic, rebound in 2021. So very strong flows, very strong indication of confidence in this part of the world. Okay, so last bit, of course, for ASEAN is your ASEP. I won't spend a lot of time on ASEP. This is one important thing that we have going as well for this for our neighbor. 15 countries, one big integrated market, largest in the world in terms of population, GDP size, in terms of trade, even manufacturing, right? Accounts for a large bulk of the manufacturing in the world, all happening in ASEAN. So this big integrated market will be beneficial for our businesses and also for foreign investors coming into this part of the world. Okay, so that is the story for China. I won't lose sleep over that situation. And then ASEAN, a lot of good things are going. So I think the prospects still looking positive for ASEAN. Okay, the last bit is on Singapore. For the next 3 minutes or so, talk about the 3 rates in Singapore. The interest rates, just now I cover a bit. So watch out for that. My colleagues will tell you more what to do with how to manage it. Higher interest rates and then inflation rate. We are going to be seeing higher inflation rate as well. Here in this case here, higher inflation rate, look at Singapore. The expectation from MES this year, we are going to see 1.5, 2.5% of inflation rate. Last year already 2.3%. This year going on, the momentum is still continuing. So for companies, we have to watch this one because the cost of operation will go up. Right, you have already shortage of supplies for some of the businesses, facing shortage of material, shortage of supplies. Now they are also facing higher costs as well. So we do have to manage that. How do we improve the efficiency? How do we improve our sales through digitalization? Right, some of these improvement in efficiency could be done through digitalization, more technology. using robotics and all other things to improve that. So we do have to manage the cost. Okay, manage your cost, interest rate costs, and then your operating costs, and for consumers as well, right? Things are getting more expensive. Your chicken rice, right, getting more expensive. Your coffee getting more expensive, and all that. So for consumers and for businesses. And then the last thing, of course, added on to these two rates is your GST rate. Okay, your GST rate is in focus this year in Singapore if you are operating in Singapore. So is it going to go through? I think the chances are, I think we are going to have to see higher GST rate, whether this year, next year, whenever. Why is it? I want to address the issue. Why is it that we have to talk about it? Is it because of the money that we spend from the reserve over the last 2 years, 100 over billion, we need to recover through GST? The question is actually no, not that straightforward. The more important question that we need to address is because, take a look at this chart. The first line here, the biggest jump in our expenditure is healthcare expenditure. That's pre-COVID, 2009 to 2019, right? 2009 to 2019. Pre-COVID, our expenditure on healthcare has really gone up every year by 13%. This is an annual rate, 13%. Because of aging population, you have higher quality healthcare, people are living longer, you have fewer children and, all sort of things. So you go to hospitals and stuff like that, and things are more expensive. So 13%. Take a look at our overall expenditure. The growth rate is only about 7% growth every year. So healthcare expenditure, really fast growth. How about revenue? Look at our revenue. Personal income tax is the fastest at 7%. 7% growth in our revenue, but your expenditure is growing at 13%, the big one. Corporate income tax, only 6% per year. And GST, somewhere down there, 5% every year, the growth rate. So obviously, we need to match our expenditure with revenue. Not simply because we want to grab more revenue to pay for what we spend from our reserves, not that straightforward. So we want to do the matching properly. Our revenue must match with the expenditure. Okay, so here, take a look at our revenue. How is it going? Okay, the top three revenues that we have are corporate income tax, personal income tax, and GST. Okay, take a look. GST is the smallest component, so do you want to leverage on revenue? That is probably one of the places to go for GST. Corporate income tax, we have the global minimum tax going to come into play. So how are we going to compete on that in terms of minimum global corporate tax? And personal income tax, we have our aging population, maybe fewer people working, and then how are we going to leverage on that part, right? So GST is one. Then the last bit I want to address is on this page as well. How about other tax, estate tax, capital gains tax? Take a look at the rest of the components, the revenue components are relatively small. So how are we going to leverage that? And the biggest driver are those flow taxes, your income tax, your GST tax, the flow taxes. Not so much on your asset taxes, right? Your asset taxes, take a look at the amount. How much are you going to increase COE? How much are you going to reduce the COE in order to achieve the kind of impact from your flow taxes? So I think GST is one of the things that we have to watch out. So grab your stuff before GST rate goes up. All right, so with that, I will end my session, and I'll pass the time back to Pat for the subsequent fireside chats. Thank you.
Thank you, Teck Hin. Now, our next topic is about sustainability, which is a key trend nowadays. It is definitely of particular importance given the current volatile climate that we are in. Before we discuss more on sustainability and how UOB simplifies it for business, let's watch this short video clip.
What does it mean for us to do right by our customers? As a bank built on time-tested values, we go beyond providing for their banking needs. We focus not only on their future, but on future generations. It requires that we be robust, resilient, and relevant, just as the bamboo is to Asia. In forging a sustainable future, we help customers steer their wealth to sustainable investments and make a positive impact on those in need. We help businesses advance responsibly by providing sustainable financing and building ecosystems to put renewable energy within reach of all. We foster inclusiveness and environmental well-being through community stewardship. To do right by our customers is our way of forging a sustainable future. For the better for ASEAN. For the better for all.
Now, a quick recap before we start. Here are the steps to follow to submit your questions to our speakers. Click Q&A panel on the bottom right corner, then select all panelists. Key in your questions and press enter. And there you go, your questions will be sent directly to us. Now, we are now back to our live studio again, presenting here the speakers for our fireside chat. First, we have Mr. Heng Kun Hao, Head of Market Strategy. He's also the moderator for today's session. Next to him, we have Mr. Eric Lim, Chief Sustainability Officer. He leads our Corporate Sustainability Office and also the Chairman of UOB's Group Environmental, Social and Governance Committee. Next, we have Mr. Edmund Leong, Head of Group Investment Banking, and he oversees the development of sustainability-related capital market solutions for our clients. Last but not least, we have Mr. Leong Yong Chi, Head of Group Corporate Banking. He also drives our bank's asset tokenization strategy and actively engage clients on sustainability solutions too. So now let's begin. Kun Hao, please.
Thank you, Pat, and good afternoon, ladies and gentlemen. Thank you for staying with us. This is the first of two fireside chats, and of course the topic is about these two big mega trends that all of us know will be very important for the years to come, which is sustainability and asset tokenization. Now, if you can give me the indulgence to introduce the three gentlemen again, right? This is, in fact, one of the few times we have three very important bosses from UOB all in the same space together. So for us to pick their brains. More importantly, they are all thought leaders in their own respective fields of work. So Eric, of course, is our Chief Sustainability Officer, CSO. Edmund is the Chief of our Investment Bank. And of course, Leong Chi is the Chief of our Corporate Bank. So here's the deal today. Now, we have a Q&A segment as well. Please pepper your questions in. I'll try to bring the questions out to the three gentlemen. But first, let's just start with a few questions just to highlight, how strongly, how passionate we feel about these two big mega trends. And suffice to say, these two big mega trends will have significant impact to transform, the banking industry, and more importantly, how you do business, how you fund yourself, how you borrow, how you invest, and how you bank with UOB. So Eric, if I can just start with you first. Now, in all our conversations, our town halls, I know you come across very passionate about sustainability, not just for UOB, but also for our customers. Now, you have mentioned before that, the firm plans to be carbon neutral in a few years' time. So perhaps, this is as good as opportunity to share with all our clients what is UOB's sustainability strategy, and more importantly, how do we help our clients to go green? Eric.
Yeah, Kunal, thanks a lot for that question. I think it's really important that as we talk about sustainability, we understand the larger structural landscape, and then we can dive into what the individual client journeys or bank support can be. Now, if we step back, we all know that in the last 12 to 18 months, the topic on sustainability has absolutely exploded in the public domain. But what's really driving it? And it's important to understand who are the key stakeholders, what the effect and implications will be on our business models, right? So the first one is obviously governments across the world. Because of COP26, because of the Paris Agreement, all of them have signed up to these things called NDCs, or nationally determined contributions. Essentially, it's how a government commits to reducing the carbon footprint. Now, why is that important? That's important because it's going to translate down to national development roadmaps. It's going to change policies as well as frameworks at a national level. think regulations. And we're all very concerned always about how regulations can shape our economies, right? A second key group that's really taken a very foot-forward stance on this are investors and asset managers. And from that standpoint, as they start to interact with their investee companies with increasing expectations on their sustainability agenda, that's going to affect things like valuation, the positions they hold, as well as how they vote, right, in terms of the companies that they hold, right? The third, and this is something that's very close to our heart, is our clients and your clients are also increasingly starting to get more and more sensitive to sustainability. And if you think about market share, think about supply chains, it's very important that us and you, we all come up with the right kinds of products, services, positioning, such that we can not only protect our market share, but increase our market share in an increasingly sustainable world. So as UOB, how do we think about this? Number one, we're extremely client-centric. And so the first thing we are very cognizant of is we have to bring our customers on the sustainability journey, because if our customers are successful, so will we be as a bank, right? We've got a wholesale business, a retail business, a markets business, as well as an asset management arm. And across each of these business models, we therefore think through what our client needs will be, what are the right products that we need to be designing and delivering to our customers, such that it's as easy as possible for them to be able to go on their sustainability journey. An example of this, we talk about the sustainable finance frameworks that are required to be able to transform and invest either business models or the cities we live in, the manufacturing models, the supply chains in support of our customers. And we've got a couple of flagship sustainable finance frameworks that are in support of that effort. We also roll out solutions. For example, we have one called Use Solar that increases the adoption of solar energy. And through that way, by bringing together ecosystem partners to our clients, together with our financing, that's an easy way for our clients to be able to adopt, for example, solar energy. I could go on, but I want to also give the opportunity for my fellow panelists to share their experience as well. But in a summary, that's...
Thank you, Eric. So the key takeaway is, of course, that UOB is working to bring all our clients and your clients as well together on this journey to become more greener. I think one of the very good examples translating to dollars and cents is in the capital market space. So Edmund, now we all know that you have also pushed very hard for UOB to issue more sustainable bonds over the past year and a few months. And this is a sector that is growing very quickly and means many different things to many people. Can we have your comments on what are the different types of sustainable bonds that everybody needs to be very cognizant of? And more importantly, how we as UOB, the investment bank, how do we help optimize our customers' borrowing costs using sustainable bonds? Edmund.
No, thanks, Kun Hao. I think from our perspective, I think the key is if we differentiate all the different types of ESG-related bonds. So if I can go to the far spectrum of like green bonds, sustainability bonds, these are bond structures which essentially has very specific use of proceeds. So these use of proceeds essentially are used for a particular project, infrastructure project, renewable energy, and so on. Then on the other extreme, you have got what we call sustainability-linked bonds. So these are structures where companies could raise these SLBs and essentially have a more corporate, general corporate purpose usage. And what we do is to make sure that we work with the corporate to essentially come up with a sustainability corporate policies that they have got certain SPD targets. And we then convince investors to say that the company wants to have this journey and essentially structure that accordingly, such that the company could have a bit more flexibility in terms of the usage of proceeds. Now, how does UOB help clients? So we want to ensure that clients don't only need to put on solar panels or have a wind farm project to be able to access this market. We could even look at a company that essentially could have manufacturing facilities. They may have a lot of rooftops, and we can essentially also raise dedicated green bond financing to essentially fund those projects. Now, on the other extreme, we could also help companies in terms of determining what their sustainability targets are, and raise a corporate style facility to essentially for them to tap the market. And the key here is that, Khun Hao, to your point about optimization of terms, this is something that we have to kind of discover over time. This is very new in the market, but we are able to essentially go to our investors to say that if company A wants to have these certain targets, and if they can achieve these targets, we could essentially lower those coupon rates. Alternatively, we could essentially price the financing at a lower rate than what they could do on a conventional basis. But if they don't hit those certain SPD targets, then there's a penalty on it. So it can be, you know, kind of a stick or a carrot in terms of how we look at the structuring.
So you know, if you heard from Edmund, I think one of the key takeaways basically, this is a process. It's not just a simple case of issuing a green bond, we're done, right? It is a process where UOB helps all of you to basically discover how you can improve and optimize your operation, right? With the end goal of becoming more greener, and in the process, if you can lower borrowing costs, you know, that's a win-win for everybody. Now, again, building on that, so we have a sustainability strategy from Eric. We have sustainable ESG bonds from Edmund. And if you follow the news, just late last year, UOB is probably the first in the industry to take one of our customers' sustainable bonds and digitize and tokenize it. Now, this is asset tokenization effectively. Now, Yongqi is at the forefront of this, and asset tokenization, you know, in the blockchain space means a lot of things to a lot of people. We at UOB pride ourselves to be guardians of our customers' wealth. So we keep at arm's length to speculative, you know, crypto trading, but we focus on asset tokenization. So maybe Yongqi, if you can share with everybody what exactly is asset tokenization, and how UOB is going about, you know, helping our clients with this as well.
Thank you, Khun Hao. Tokenization is quite an interesting buzzword to use, right? I think if you look at the fundamental principles behind asset tokenization, we're talking about blockchain and the use of such technologies. Now, by and large, I think what's highly visible to everyone is the space of cryptocurrencies. But that remains highly speculative. That remains an area which is still subject to developments in regulations around the world. And it's also an area where from a guardian of our customers' wealth and business perspective, is not an area we see as an immediate priority. So if I put things into context, if you look at cryptocurrencies, it's a market that's roughly depth of $2 trillion at the moment. But if you look at Edmund's business and world, where we're talking about equities and bonds, that depth of market is about $142 trillion. Now, our focus in the immediate future is to look at how we can help in terms of our clients journeying towards tokenizing some of their capital market securities, be it equities, bonds, or even physical assets. So we're approaching tokenization, Khun Hao, from the perspective of what's relevant, what's commercial, what's important in terms of our clientele. We hope at some point in time when the regulations around cryptocurrency is better bedded down, it's an area that we would love to pursue as well. But at this current juncture, I think it's still evolving.
Thank you, Yongqi. So you see, we work in line with the regulators, and basically right now, the technology is there for us to start to tokenize not just the capital markets product, but also, as what Yongqi says, real estate as well, and physical property. So if you've got any property or asset that you think you want to tokenize, you know who to call, right? So, okay, so that's that. I'm just setting the stage, and that's more of the broad framework in terms of sustainability and tokenization. So we move on. There's a few questions coming in the iPad, and this next phase of the roundtable, I want to ask a few more candid questions to all three gentlemen. So Eric, now we all know about going carbon neutral. We all know about lowering carbon footprint, right? And of course, we all heard about the controversies of greenwashing, so on and so forth. So perhaps if you can share with us what you think are the practical limits, and more importantly, how do customers really go green instead of just buying a carbon credit, putting in their books, and then that's it? Obviously, that's not the way to go. Yeah. Eric.
Yeah, I think that's a great point. In this big rush for everyone to be sustainable, there are the right ways to go about it. There are the, let's call it, the wrong ways to go about it, right? And so I think the most important part as any corporate or a bank goes on a sustainability journey is, number one, it's got to be authentic to the business model itself, right? If you are in the business of banking, for example, and your sustainability journey is doing more volunteering and maybe converting your company cars to EV, that's not core and central to your business model, and you're going to get called out for that relatively quickly. So the first thing that's very important is, as we look at each of our business models, understanding essentially the value chain, right? What do we consume? What do we value add? Who do we sell to? Understanding the entire supply chain. And then being able to understand the sustainability implications along the entire value chain itself. Now, sustainability also has the environmental aspect, the social aspect, the governance aspect, and they're all very important. But right now, the big focus tends to be on the environment or carbon emissions. So that's a good way to start, because that's what the market is very focused on as well. Now, many of you may have heard of very technical terms like Scope 1, Scope 2, or Scope 3 emissions. If you haven't, don't worry about it. This stuff is not difficult to learn, but it's really simply understanding at each stage, where are we consuming more or emitting more of our carbon footprint versus where we could be making tweaks to our investments, our processes, our purchasing choices to be able to reduce those carbon footprints, right? The reality also is, in many of the jurisdictions in which we operate, the national governments themselves have not committed to a net zero pathway by 2050, or even as they've committed to 2050 or 2060 kind of carbon neutrality path, some of the frameworks and regulations are not very clear yet. So where does that leave us? It leaves us to be in a position where, as we make our investment decisions, right? Because investment decisions run 5, 10, 15, possibly even 20 years. And we know that over that time period, whatever we invest in is going to be subject to changing sustainability-linked regulations or implications, that we kind of look forward a little bit to say, are carbon taxes, for example, going to significantly impact my profitability in terms of cost? The market share in which I'll be selling into, if it's in parts of the world where they're going to be much more sensitive to how our manufacturing or agricultural practices may be, to be able to start taking those into account in today's investment decisions, right? So that as we rework a plant, relook a supply chain, or choose vendors, we become more and more sensitive to those decisions, right? Now, the reality also is that with each year, the sustainability bar is going to get raised. So it's very important that while we don't crack world hunger all at one shot, that we also don't adopt we will wait and see, right? Because the work needs to get started. It just needs to be done in consumable, logical bits that is relevant to your particular business model. And when in doubt, speak to your banker, right? Our bankers are well trained to be able to support from an advisory or even financing perspective.
So Eric has basically mentioned quite a few important things. If I can pick up two things. One is the sustainability process is a long game. This is not a short-term thing, right? 5, 10, 20 years. Plan ahead, look ahead for the changes in the industry, and what you can do to basically, meet these challenges up front. And the other thing is, of course, again, please call your bankers. Sorry, this sounds a bit like a marketing, but we are all well prepared and very, very, how should I say, keen to embark on all this journey with you. And we do have a proper game plan in terms of how to work towards that. So that's on the sustainability front. Now, there's a question here, Edmund, basically, in capital markets. The direct question is this. So we all know that ESG bonds are important, but, we are in the middle of ASEAN, in the middle of RCEP, right? What are the other new focus and mega trends for the capital markets across ASEAN this year that investors should look forward to, be it in DCM or ECM space? What do you see in the capital market space besides the ESG stuff? Edmund.
Thanks, Kun Hao. This is a very, very good question. I think if I can throw a few numbers and stats around, we are actually just getting started with this, right? If you look at the Sing dollar bond market, it's an annual volume of about $25 billion. 2020, we hardly had more than $1 billion worth of ESG-related bonds. Last year, 2021, it closed with $4 billion. So the market has gone about 4 times higher. And it's really only about 15 to 20% of the overall market. And to pick up what Eric said about stakeholders, right? One of the major stakeholders is really investors. There's tremendous investor interest in this space. We're seeing all the way from multilaterals. We've got, in one of the deals that we did for Samcorp last year, we have IFC, which is part of World Bank, being an anchor investor there. We also had, a lot of institutional investors, the life insurance companies, asset managers, all increasingly want to have more allocation for such bonds. We have also banks who are very keen to do that, as well as even individuals, private banking clients, AI investors. They are curious. They want to, put more of their, assets to work in this space. That's really the bond market. If I really look at the bigger market of the debt world, is really the loans market. And the market that we, from a UOB perspective, are extremely active in is the Asia-Pac loan market, ex-Japan. And if you really look at that, ESG-related loans, so these could be green loans, real estate green loans, plus some of the sustainability linked loans, that market has gone about 2.5 times higher. So 2020, it was about 28 billion US equivalent of loans. 2021 is 73 billion. So, but if you really look at the broader, loan market, this is the $600+ billion market. So there is really, we are just scratching the surface, right? So from our perspective, we are working with clients in a very big way in terms of trying to firm up their corporate policies in terms of how they want to tackle sustainability, targets and so on, and then see as to how we could bring them to the market. And it's not only going to be only on the currencies that they are essentially targeting, right? We could also do a lot of cross-border transactions, and I think we foresee in Singapore itself there will be a lot of foreign issuers who will start coming into Singapore to tap the market out here as well. Now, away from the debt world, there's also the equity capital markets. And then from a, say, UOB asset management perspective, we have actually worked with SGX to devise a ETF that essentially invests into REITs, real estate investment trusts that actually, have get to a point that they, that this group of REITs, which we think that they have already gotten established policies of going green. So whilst we come up with this ETF, this also, enable the stakeholder like investors to be able to invest in these ETFs. And from ECM's perspective, we can also start, engaging a lot with our corporates clients who essentially want to be part of this index, and this is also the journey that we're happy to go along with our clients.
So if you hear from Edmund, there's a lot of things happening in our region: Sing dollar bonds, ETFs, index, and of course, and your local DCM stuff. Now, the simple thing, I guess, as a market practitioner we can say is you want to go where the liquidity is. And especially if you want to borrow, go where the liquidity is, where the market is growing, then you can borrow at a lower cost at a much more optimized level. Now, thank you, Edmund. Now, Yong-Chi, just building on this tokenization thing, I suppose we can also tokenize currencies. That's what this is about, and that's so-called the holy grail of the blockchain space. If you can tokenize currencies, make it much more efficient, central banks will able to transmit monetary policy much more effectively, and financial markets will be much more safer, less volatile world. The big one, of course, right now is central bank digital currencies, and the attention is there because next month, in a few weeks' time, Beijing Olympics is coming on, and we have got into several conversations with our clients ourselves. They're all asking what's happening with the digital renminbi, 数字人民币, central bank digital currencies. So perhaps, Yong-Chi, if you can share with all of us what exactly is a CBDC, and more importantly, what UOB is doing on this front, working with various regulators to help our clients. Yong-Chi.
Sure. On central bank-backed digital currencies, if you think about currencies in the first place, it's a tool, it's a policy measure that central banks around the world use to manage economies, right? Now, it's becoming quite popular to use cryptocurrencies these days, and when cryptocurrency is growing at a clip of 150% year on year, and is starting to replace some dominant forms in terms of how people transact, how people pay for services and products, it does cause worry amongst central bank policymakers. So it is not surprising to see that central banks across the world are now rushing to quickly put in place either regulations to regulate cryptocurrencies or put in place a mechanism where their own currencies, paper currencies, can be used in a digitized format, and that's how it's evolved to be central bank-backed digital currencies. There was a survey done in Singapore by Gemini, Seedly, and Coin Market. Now, they did a survey of over 4,000 individuals who have self-identified as investors in investment products or who have an interest in investment products. And out of these 4,000 respondents, a good 67% of them indicated that they have invested in cryptocurrencies. Now, what's more interesting is in the context of the investors who have invested in cryptocurrencies, 80% of those who have invested in cryptocurrencies are under the age of 34. Right? Now, you're seeing a huge demographic shift of people who are younger, who are more tech savvy, adopting the use of cryptocurrencies as a form of payment, as a form of investment. Now, that shift is very monumental if you imagine as this demographic of people change and move and grow in terms of income, wealth accumulation, they will one day become the dominant pool of capital. Now, we are anticipating this to come in the next few years, and clearly we are positioning ourselves. So from a UOB standpoint, we are working with the various regulators and central banks around the region. We are participating in trials. We are also involved in several projects which are looking at implementing the adoption, the use, the ability to transact in such central bank-backed digital currencies. I would caution again that this is a fairly early and nascent stage of development. While some of these currencies are being formulated, are being put into plan, you require an ecosystem. So just because you have a currency doesn't mean that people will use it. You need the currency format, the regulations to be in place. You need the market to be ready for it so that the demand and supply forces are balanced. And I think that will take some time to percolate before it becomes mainstream.
Thank you, Yong-Chi. The only statistics I hear from you is that 80% basically of those who invest in crypto and digital currencies are below 34 of age. I like to believe, no. I like to believe that the rest of us outside of this age group invest in crypto and digital currencies smartly, right? So, okay, so the questions are coming in, getting a bit pointed. There's a question on the cost of going green, Eric. Carbon futures are going through the roof. And you know, there's a bit of criticism that in this process of going green, we're driving up the prices of oil, driving up the prices of electricity, so on and so forth. So what's your comeback to that?
Yeah, I don't think there's a smart, quick comeback, right? But more a recognition of the reality of how economies are transitioning. The reality is when you're doing something as big as taking an economy that was built based on fossil fuels for the last 50 and 100 years and honed to be extremely efficient, that as you transition towards a future economy that is not fossil fuel based, but renewable energy based, et cetera, you're going to get massive dislocations, right? That's simply the reality of investment cycles. The question is, where does each of our business models fit within that very tricky minefield? And how do we, very intelligently, find our way through without getting our proverbial feet blown off, right? The one thing I will say is it's important to both see the risk as well as the opportunities of moving on a sustainability journey, or not, right? I'll give you a simple example. In the EU, there's already debate around regulations on this thing called a carbon border adjustment mechanism. And essentially what it means is in the EU, they already have carbon taxes, per ton of greenhouse gas emissions, but they recognize in other parts of the world, those carbon taxes are much lower. First, trust me, carbon taxes are coming and they will only go in one direction, which is up. Number two, with how EU is thinking about this, as they import goods from other parts of the world, they may impute what the greenhouse gas emissions of your product being, and then apply a carbon tariff on top of that. So simply because we're working in a particular jurisdiction that doesn't have aggressive carbon taxes yet, doesn't mean your supply chain eventually doesn't touch such high carbon tax jurisdictions. So it's important, like I said, to look forward and understand these implications, and not only perhaps count the cost of going on a sustainability journey today, but to count the cost of not going on a sustainability journey. And if you start to see that there are risk of losing market share, revenue streams, or regulatory costs, then it completes out the full picture in terms of how and where you really need to focus. Now, it's also a fair point that you don't try to do everything, right? As with life, it's always a competition. So it's always very helpful to benchmark your particular model versus the field or your competitors, your industry. And there is safety in numbers, right? You don't want to be the last in the herd. And sometimes to be at the front of the herd, yes, it does cost a little bit more, but you want to make sure you're probably in the first, top quarter percentile, because as the wave of sustainability regulations moves, it's going to move quite fast and quite aggressive. And it takes us time to rework our business models. So you want to get a bit of a head start, not get too far ahead, but definitely if you're sitting here wondering whether you should embark on the journey, our strong words of encouragement to you is, please do, don't get caught up.
So you heard from Eric, right? Carbon taxes are coming, there's no going around it, and it's going to go higher eventually. And I do remember Minister Lawrence Wong, he did hint that, the finance ministry is doing a study of what is the cost, of each carbon offset. So yes, it will hit us eventually. Yongqi, this hot potato goes to you, and I think you can see it coming. NFTs, what are your thoughts? They say that this is even more exciting than asset tokenization, that we should buy virtual real estate NFTs before, it's expensive. We should buy a piece of Singapore, Orchard Road, before anybody else. Your thoughts on NFTs, Yongqi?
Interesting you should bring that up. It's a topic that we've all been watching, and I'm sure many of you are amused when you see art pieces or dogs or certain instruments that have been sold online as NFTs, right? Even songs, lyrics, music have been sold as NFTs. And you've got teenagers who are in, well, not teenagers, but 20-somethings who have made millions and have become, crypto billionaires, millionaires overnight, trading NFTs. As a concept, again, if we go and look at the fundamentals, the tokenization using blockchain, right, to be able to identify a certain piece of art, a certain animal, a certain person, I can understand that. But when that piece of NFT becomes astronomical in valuation, that's the part where I struggle to comprehend, right? So it's a question of demand and supply. Maybe everyone is rushing and putting capital into this space without understanding it. Or perhaps I don't understand it well enough, but I just do not see NFT's valuation being sustainable in the long run. At some point, there will be some recalibration in terms of demand, supply, as with all instruments and all markets. And we might see some pullback in terms of valuations and NFTs coming back to ground. Yeah. But in the meantime, I would say, it's an important aspect of the journey towards using digital instruments, and it's certainly an area that we cannot ignore.
And if I can add to Yong Chi, I guess, if we follow the crypto and the digital market space, starting from when Bitcoin first came on board, there will be always rounds of bubbles, right, of new experimentations, and then, the better technology is picked up, and then it's reinforced, and then it grows, and the momentum grows. If you remember, a few years ago, there's the ICO bubble. So maybe, after this round, it'll be a very different thing for NFTs later on. Edmund, I think this is coming to you as well. Strictly not in the frame of the two mega trends, but you're the investment banking chief. Interest rates are going up. Jay Powell says, 3, 4, or maybe whispers 5 rate hikes this year. Fixed income space is very painful since the start of the year. Perhaps an investment advice to our customers. How do they invest in the fixed income space if interest rates are going up? Edmund?
Yeah, I think we can look at it from two ends, right? So if a lot of our clients here are really issuers, right? When you have a rising yield curve and all that, so if you do have requirements, our position is to really tell the clients to essentially really try to pre-fund a lot of your requirements. We have a segment later that talks about the trends and all that. I'm sure it will be a robust discussion there. But we do really want clients to essentially tap the market. And if you really look at the rates, the US dollar rates obviously have gone up. I think the local currency rates in the region that we are operating in has actually not gone up that swiftly. So we are pushing a lot of our local currency desks to essentially speak to clients, especially if they've got local currency requirements. Now, if you flip it to the other side in terms of investors, I know that fixed income as an asset class has been fairly painful, especially those who have gotten into the longer dated ones or even perpetual securities. So the advice would be really try to stay short in terms of your investment horizon, because there may be potentially better opportunities when rates start to go up, and then you could essentially be able to lock in your investments at a higher rates.
So pre-fund, keep your duration short, and look for opportunities in local markets where rates hasn't really went up higher. So 3 key takeaways from Edmund. Okay, so we're coming to the end of our segment. I guess I'll do the obligatory question to all 3 gentlemen. If I were to ask and insist on one most important advice to all our clients that you think they need to do right now after this webinar, what will be your advice to our clients? Eric?
Yeah, I think in the space of sustainability, one advice I will give is cast your mind out to the year 2030. It's fun, right? It's 8 years out. It's not too short. imagine what the world's going to look like from a sustainability expectation, economy, technology perspective. And then imagine your own business model. Are you a leader in that space and doing commercially well? Or are you, kind of a bit on your back foot and therefore going to be commercially challenged? I think once you have an honest sense of what you look like in 2030, you'll be able to understand perhaps for the next 8 years what you need to be focused on, the amount of work, and it will guide a lot of those key strategic, investment, or tactical decisions.
2030, be one of the top customers of UOB.
Yes.
Okay? Edmund.
I think the advice that I would give is it's never too late, right? So, if you already have a policy that's great, then come to talk to us to potentially, go out to the market or time the market for yourselves. But if you do not have a policy today, my advice is don't procrastinate, right? It's never too late, but don't wait and not be at the forefront, like what Eric said. Try to stay ahead of the curve and all that. And then we do have the right tools to essentially help clients, and we have the tools not only for the large corporations, financial institutions, and so on. We also do help a lot of the smaller companies, the private companies, because as what Eric said, we have got those sustainability financing frameworks where they could adopt with us, such that we could also be able to help our clients to adopt those financing frameworks.
So it doesn't matter if you're a large GLC, large FI, or a small SME, you're equally important to UOB, right? We'll be there for you. Yong Chi, your word of advice.
I like what Eric and Edmund talked about, right? You need to look a little further from the current horizon. You mustn't procrastinate. And my wish for the corporate clients of ours is that when you think about a football game or a basketball game, you need to run to where the ball is going to be and not chase after the person with the ball, right? So if we plan that forward, and if I apply that from the asset tokenization, digitalization lens, look beyond just tokenizing of assets, beyond NFTs, beyond currencies. A lot of the technology that's underpinning blockchain and asset tokenization, many of them have a use that will inevitably help you be a lot more efficient with your productivity, with your processes. So when we think about that, we are looking at the application of blockchain in terms of processes that we handle within the bank or processes that we do with clients as well. Right? So it is a tool that is taking us from the analog way of doing things to the digital way. And we've seen that transformation happen many times across different industrial revolutions. And I think that will happen here as well. So try to get to where the ball is going to be.
So we are in a football game. Get to where you think the ball is going. More importantly, there is now blockchain algorithm to help you figure out where the ball is going. So on that note, thank you, gentlemen. Thank you, Eric. Thank you, Edmund. Thank you, Yong Chi. I hope, ladies and gentlemen, you've picked up some good tips from here. We'll take a short break. We'll be back with the second fireside chat. Thank you very much.
Thank you, panelists. That was such an insightful chat. And I think all of us have got a lot of tips already. So we can look forward to 2030. But before we start for the second fireside chat, here's a short video of an FX and interest rate forecast. Before we start that, let's have a look at the short video. Thank you.
Every time a business opens its doors, it opens up possibilities throughout Asia. And while some doors close, the will to try again never dies. There's nothing small about their commitment to Asia's future. And there's nothing small about our commitment to yours.
Now, we are back live again in our studio, presenting to you the next set of panelists. We have again Mr. Heng Kun Hao, Head of Market Strategy. He is also our moderator for this session. Next to him is Mr. Peter Chia, FX Strategist. He's responsible for crafting FX hedging and investment strategy for our clients. Next to him, we have Mr. Victor Ong. Victor Yong is the interest rate strategist. His primary focus is on Singapore with secondary coverage on ASEAN and the G10 currency. Last but not least, we have Ms. Eileen Chia, Group Head of Global Market Sales. She heads our sales team globally, which deliver hedging, funding, and investment solutions across all asset class. Now over to you, Kun Hao.
Thank you, Pat, and thank you, ladies and gentlemen, for staying with us again. The second of 2 fireside chats. This one will be much more in detail, much more dollars and cents, and much more relaxed as well, of course. And we're going to basically focus more on, FX and interest rate discussion. So I think at the very beginning of this webinar, all of us heard from Tekin that UOB sees 3 Fed rate hikes coming, right? Specifically June, September, and December. And if you read our research report, there's a few core views. First, of course, US dollar is getting stronger. Secondly, interest rates are going up. And as Victor says, short-term rates is the exciting part. And third is, of course, commodities will be volatile as assets adjust to a higher interest rate environment. So Eileen, perhaps, let me just ask you the first questions. You have had a lot of conversations with clients, right? Are they still complacent about US dollar risk, given that you can see the US dollar strength coming towards us?
Thank you, Kun Hao. I think we've seen clients' behavior evolved over the last 2 years of COVID, throughout the pandemic. I think at the beginning of the pandemic, clients were facing uncertainty in their cash flows. So they were doing more of the spot conversion or shorter dated hedging, as they were not sure how long is the pandemic going to last, whether the impact on the business will be more severe than expected. But we saw that change over the last year or so, where the economic conditions got better and there's more clarity on the business cash flow. So we saw them stretching the hedging tenor towards the, 6 months and a 1 year tenor. And I think going into 2022, with the expected trade flows and FDI flows picking up as what Tekin had shared earlier, we think clients' FX exposure is going to increase. So, in fact, since the end of last year, we have started sharing this view of dollar going up. And that's when we see customers are getting more disciplined. Whenever there's a dip in dollars, we saw more hedging activities going on. So I think the key message that we need clients to know today is, if you have dollar payables, you've got to watch your exposure very closely, engage with our salesperson on various hedging strategies. And I think today is a good session where Peter can share more on his views on dollar Asians, exactly how high are they going to go from here. Yeah.
So I think Eileen is very polite. If I can put words into her mouth, everybody needs to be a bit more disciplined in terms of FX hedging. So Peter, now, Tekin, Eileen, all of us, we all know that, this is the year for ASEAN. And this is the year where RCEP, has started. We get a lot of questions, all the time about how our regional currencies in ASEAN will do this year. Is this a simple case of Fed hiking, US dollar going higher, or ASEAN currencies going lower? What's the dynamics for, let's say, Malaysian ringgit, Thai baht, Indonesian rupiah, and Vietnamese dong? What can you expect for all these key ASEAN currencies?
Yes.
Victor, Peter?
Yeah, so the broad direction-wise, I think it's quite clear by now that dollar ASEAN is heading higher. And there's a lot of supporting factors why is that so. And I think the clearest of them all is like what Tekin has mentioned, 3 rate hikes for this year, and tapering is coming to a close by March. And I think something that really surfaced out in the last 2 weeks is the possibility for the Fed to even consider to run down their balance sheet this year. So these are all positive reasons why the dollar is heading higher, and potentially it could spur a wave of portfolio outflows from this part of the region because of the fact that we have a relatively subdued year last year. It gives investors or clients some thought that maybe this year will just be a repeat of last year, but there is a key difference. The key difference is that this is a year of policy change. Last year wasn't that case, and this year we'll see when the Fed really hiked rates potentially in June. Some were saying that as soon as March, we will see the impact on currency coming up. And in the first 2 weeks of this year, we already seen that interest rates has adjusted higher. It will just be a matter of time where higher interest rate will spill over to the FX market and lead to higher dollar against Asia. But I think the important risk I think we need to take note of is Omicron. Because so far, I think thankfully in this part of the region, it is not as, the tsunami hasn't really come to this part of the world yet. But if you look at what's happening in US and Europe, I think we have to be very cognizant that it could be a repeat of Delta or even worse. In a case that FX volatility could go up again, the recovery plan could be 3 steps forward, 2 steps back, and the sentiment on currencies in this part of the world could be dented again. So overall, if you just look at these two things, it could be something, it's quite clear to me that dollar Asian is going higher. And I think the final point I want to point out on the direction-wise is that in this part of the world, inflation is not as featured as strongly as the developed market. So inflation in Asia has been subdued somewhat. So if we do see that whatever that's happening in the developed space, meaning US, Europe, spill over to this part of the world, as in we can see higher inflation in this part of the world, that could potentially cause some volatility in the regional fixed income market, which will inevitably then confidence in the currency. But to just go into the details of some of the currency pairs, I think I'm watching the Indonesian rupiah very closely because last year it was a very, very stable year, contrary to a lot of expectation of a massive devaluation because of the Fed taper. So this year, I think the dynamics are right that Indonesian rupiah being an emerging currency could see some volatility and prone to downside. And so in the scope of ASEAN currency, we are a little bit more cautious on rupiah. And last year was a terrible year for the baht, and it dropped like 10%. So if you look at history, typically 2 bad years for a baht it's not the norm. So after a big slide last year, I think this year, no doubt that the dollar is going higher. I think the potential drop for the Thai baht this year will be a little bit lesser compared to what we are expecting. So watch the rupiah. I think don't get too negative on the Thai baht for now.
Thank you, Peter. Now, I did read in the Feng Shui almanacs that the tiger may be a bit more friendly to the Thai baht this year. so let's see, right? Tiger, Thai baht. Now, Eileen, moving on to interest rates, right? Same question to you. Is it still the complacency or the reluctance to cross the carry, right, for interest rates? Because rates are going up, curve has got, much more difficult to cross. What are our clients' attitudes toward hedging interest rates? Do they believe rates are going up?
I think this year they definitely believe rates are going up. And in fact, now if you meet the clients for lunches, the first question is 3 or 4 or 5. It's not about whether is it going to be hiking or stay put. So I think people have accepted the fact that rates are heading higher. But in terms of customer response to expectation of rate high, I would divide them into 3 groups. I think the first group is the more proactive and more disciplined one, I would say, where since last year, third quarter, where inflation risks start to creep up, we saw them putting on IRS's interest rate swap to swap their floating rate exposure into fixed rate. So there's one group that did that quite diligently since third quarter last year, and there was also some activity in Q4. The second and third group were more apprehensive. Second group is because mainly of the transition into the alternative reference rate like SOFR and SORA. I think there was a lot of hand-holding and education needed, and we needed to work with the RM to ensure that the loans and the hedges are transited smoothly as well. So that part is still ongoing, and it will still be a work in progress in 2022. Then the last group of client, they are apprehensive because Omicron happened in the last quarter. So with that, we all know that interest rate swap level has jumped significantly. If you look back at the chart, it's just one way up. I think most of them are up average of about 1% across all tenors. So it's becoming quite expensive and quite difficult for them to explain to their bosses on why you want to put on a hedge now with such negative carry. So when Omicron appeared, this group of clients are, okay, you know what, maybe we wait and see. Maybe there's a pullback that can enter at a better level. So these are the group of clients that's monitoring the rates very, very closely right now. But I would say most clients are agreeing that rates are heading towards one direction. It's just the magnitude that we need to understand a bit more. So I think Victor is a key person here to share that view with our clients today.
But Eileen, the
Yes.
question is this. We all know rates are going higher. Is it too late to hedge?
Is it too late to hedge? I think Victor is in a better position to answer this question. I think it is quite expensive. I can understand why clients are hesitating at this point. However, right now, it's not about a case of cost saving. I mean, you look at the market, it's already pricing in 3 to 4 hikes. I mean, I think we shouldn't expect SORA to stay at the 0.2% or less than 0.2% level. In 1 year's time, I think we're looking at a different range altogether. You'll be the 1 to 2 or even 3% level, depending on how the market evolves. So I don't think it's too late to hedge, but I think it's important to watch the market proactively so that we are ready to put on a hedge when the opportunity arises. Yeah.
I understand.
Yeah.
So now, on this note, now, Victor, I remember in your quarterly report, in your segment about interest rate strategy. Now, one of your comments, very vivid to me. You said that short-term rates are coming out of hibernation, and to me, the word hibernation conjures up this image of a big brown grizzly bear, right? Coming out of hibernation, very, very angry, very upset. So unless you are Leonardo DiCaprio, you do not want to stand in front of a big brown grizzly bear, right? So you do not want to stand in front of rising interest rates. So the floor is yours to scare everybody. How high do you think short-term rates will go, US, Singapore? And how high do you think the yield curve dynamics will go? What do investors and customers need to worry about this year on the rates front? Victor.
Okay, so thanks, Kunal. Thanks very much. With that said, I can feel pressure from my left and right in terms of how we view interest rates going. I mean, if you sitting through this webinar, you would have gotten a sense that what our expectations are already. In essence, it should come as no surprise to our forecast, mainly because, I guess if I was to take a stab at it, everyone here in this room would have experienced inflation on a personal level to some degree over the past year already. So for that reason, I'll recap our forecast on the Fed funds, which is 3 rate hikes this year. In fact, this is not just the Fed that is going to hike rates, but a broader base of central banks across the world looks set or already are hiking their interest rates and tightening monetary policy. The big exception perhaps is China, but the vast majority of the rest of the world is already tightening. Singapore will be no exception. We have an expectation that the MAS will allow a larger room for appreciation for the Sing dollar this year as well. So with that said, it follows with monetary policy tightening being our base assumption that your rates across the board, this stretches from your front-end LIBOR, SOR rates, SOFR rates, risk-free rates, all the way to your bond yields, they will have a tailwind to reprice yields higher, right? And I want to go back to the observation that Eileen made in terms of the last class of customers, which is a bit hesitant. For those who are here, for that segment, and if you are here with us today, I would like to emphasize that the key word here when we talk about monetary policy tightening is that it is a cycle. So cycle is the key word. Historically, when we look at monetary policy tightening cycles, this have lasted somewhere around the region of like 2 years or so. And if you look at the more recent data, so the post-2000 data, right, this monetary policy tightening cycle
has averaged at around 2.75% increase in the Fed funds rate, right? So we use the US as an example. If you like, 2.75% is basically 11 clips of 25 basis points rate hikes, right? So this cycle term is important to bear in mind, because a lot of times when you see the newspapers and when Eileen has their conversation with the customers, they are focused on the immediate, what is the immediate response from the Fed. But you are looking at a 2-year cycle. So clearly, if rates were to rise over the course of 2 years, then the trend is really not your friend in terms of putting things off, right? The one area that we think about, because Kun Hao's also mentioned about how I should be selling you the scare story. True, there are vulnerabilities as well, right? In terms of we've all heard about how with each FOMC, almost like with each FOMC, the immediate response is to go and reprice the front end rates, reprice how many rate hikes you expect. The back end of the curve has gone higher as well, so your longer maturity yields have gone higher. But if we look at it from a broader perspective, right? Like, if you look at the whole history of it, where we are right now, it still can be called generally low still, right? If you look at the 10-year US Treasury yields, for example, it's not just low on a historical basis, but it's also low when it's compared against the Fed's own projection for its long-run projection for where the Fed funds rate ought to be. And we are also getting into that stage or transitioning, moving into that stage where the demand and supply outlooks becomes a bit more challenging. What I mean by that is that we have the Fed, who is largely a price-insensitive buyer, slowly taking, or not slowly anymore, more aggressively taking steps back away from the market. At the same time, fiscal policies are being run in such a fashion that the demand for bond supply, bond issuances to fund deficits, that still largely remains in play. So what this means is that we can see, perhaps for this year, scenarios where there are sharp spikes in yields. So that's something to be wary of. But again, just to balance things off a bit, clearly there are limitations to how high yields can go, particularly when you consider the broad swath of asset classes. There are many pockets where it is the valuations are richly valued, right? So that could serve as a sort of circuit breaker, if you like, to how high yields can go. We also have an eye on the fact that the global debt, accumulation of global debt is in the region of $300 trillion already. So the question really is how markets are able to digest interest rates, higher interest rates. If it goes up in a moderate fashion, a controlled fashion, that would be ideal. But if things should get volatile and we get sharp spikes in yields, then I am a bit more concerned in terms of broad financial conditions.
Eileen, you're nodding your head. Please. Yeah.
Yes, can I pretend to be the moderator and ask a question on behalf of clients? Because you mentioned an interesting history, which is usually in a cycle on average is 275 basis point, right?
Yes.
So this round, because we always talk about this year, but you are right, you should let the customer know in the next 2 years, what do we see in terms of the rate hike magnitude? Maybe I think that would be something that clients are interested in both the US and the Sing rates.
Yep. So when you plot out the entire history of like Fed funds rates, you can sort of tease out a story that the ultimate peak plateau in each cycle has been coming down lower and lower. So it could well be, and there are good reasons that could support it, that in this time round, we may not hit the previous high in terms of where the ultimate Fed funds will level off at. For us, our projection is for it to level off at around 2.25 to 2.5%. So we are currently at 0.25, so that gives us another 200 odd basis points to go. across this cycle. Our cycle is also our projected cycle is also around 2 years. So that's what we're looking at. The FOMC members themselves, as of the latest dot plot, has a long-run projection, and their long-run projection is for the Fed funds to hit 2.5%. Yep.
Okay, so around 200 basis point or more in the next 2 years. Now again, we're not singling out any particular type of clients, but everybody, please remember what Victor says. Okay, so that's the scare story on interest rates. We've got a few questions now coming in fast and furious. I think everybody is now warm up. On FX, right? Peter, this goes to you, right? Renminbi, I think we get this a lot, right? You get this a lot. Why is renminbi so strong? Yep. And what's our view for the renminbi this year? And extending to that, what's your view on the Singapore dollar? Because everybody says, just look at where renminbi is going. This is where Sing dollar is going. So Sing and renminbi outlook this year.
Correct.
Peter?
So Kun Hao, you're right on the renminbi being very strong. Just to recap what the renminbi did last year, the renminbi appreciated 2.7% against the dollar in 2021. And against its trade partners, which is a well-watched index called CFAX RMB index, the renminbi actually jumped by 8% last year. So it was, in both ways, this is a very strong move. And we have to understand why is the renminbi strong or was strong in the first place. And there are two key factors underpinning this strength. One of it is, if you remember the COVID crisis, China managed to pull it off pretty well, even at the current stage where they insist on the zero COVID strategy. So in a way, their growth is secure. And unlike other economies around the world where you have this volatile growth calibration, China didn't have any of that. Growth was very steady across 2020 and 2021. So that's number one factor. Growth is strong. And the second factor was monetary policy-wise. China, in terms of People's Bank of China, they are very steady in the last 2 years. They have not slashed rates in a big way. In fact, they just did a minor recalibration. And because of that, if you contrast it to US, that slash from 2% to 0%, no prizes to see which is a stronger currency. So if you just look at the last two factors, that's the reason why the renminbi is strong in the last 2 years or so. But these two factors have now turned against, or will start to turn against China in the coming months or in the coming year. If you look at growth, you've heard from Tekin that growth will moderate somewhat. Last year was a blockbuster year for China, 7.9%. This number will drop to about 5.7% this year. So if you remember pre-COVID, China was doing just above 6%. So we are going back a bit lower to pre-COVID. So this is a big adjustment on growth itself. And on the second point about monetary policy, we will see this big divergence with that of the US. US, like what we have emphasized, is on this rate hike cycle, potentially 3 or more this year. China, on the other hand, is on a rate cut cycle, or rather an easing bias. They have already started to ease their policy in terms of RRR, the reserve ratio requirement, and we will see more of that in the coming year. We also see more LPR, or what we call the loan prime rate cuts. We see another 10 basis points. But I think the direction is very clear in terms of policy bias, that monetary policy is positive for US and slightly negative or supportive for China. So both factors will start to turn against the renminbi this year. And I think it's just a matter of time where we see the dollar CNY hit higher. So our forecast for this year is 655 versus the current level about 637. So I think it's a matter of time where we will see this adjustment, and so get prepared for that. The second thing that we want to talk about, home ground, is definitely Sing dollars. And you're right, Kun Hao, that Sing dollars does follow the renminbi. So last year we've seen that when renminbi is strong, Sing dollar also inherits part of the strength also. So in a way, dollar Sing didn't rise that much last year. In fact, if you look at the year in totality, we only managed to rise 300 points, in fact, from 132 at the start of 2021 to 135 we end the end year. So, I mean, you look at it, there's a lot of volatility in between, but it's just 3 big figures. So, and a lot of it has to do with the resilience of the renminbi. But I think the year ahead or in this year, we will see that the dollar Sing not only will follow dollar CNY higher, and at the same time, it also take direction from the general broad dollar strength that we argued about. 3 rate hikes is enough to support the dollar Sing higher. And I think I want to clear this idea in some of our clients' minds that, just now I thought you were saying that MAS will tighten policy this year. How do we reconcile? I mean, does it mean the Sing dollar will turn strong and dollar Sing? I think there are some banks out there that calls for $132 Sing, and I want to set this thing straight. What the MAS regulates is this thing called the SGD NIR. This is what the MAS really looks at, and in its policy meeting, it maintains the slope of this appreciation of the Sing dollar, not against the US dollar only, but against a basket of currency. So the key word is against a basket of currency, not only the US dollar. So we could have this situation where the Sing dollar NIR is allowed to appreciate because the MAS is tightening policy, but at the same time, dollar Sing is going higher. This will happen in a typical rate hike cycle for the Fed. And we've seen that before in 2013 to 2015, where the MAS allowed the Sing dollar to appreciate against the basket, but at the same time, dollar Sing is going higher.
So what this means is that dollar Sing will rise lesser
Correct,
than the rest
correct.
of dollar
Yeah,
Asia.
so
right?
Sing dollar will weaken lesser compared to the rest of its trading currencies versus the US dollar. Yeah.
So Eileen, you've been nodding her head again. Yeah.
Yes, as you're talking, I'm thinking about what questions customers may have.
Right.
And one question I have on the FX front is, do you think this dollar uptrend is going to be in sync with the rate cycle tenor? Meaning that, Victor was looking at like a 2-year tenor for rates to go up. Do you think this dollar uptrend will go the same way as well in the next 2 years, or is it just a shorter term view? And the question I'm asking is because a lot of clients have investments in China. Yeah, so right now, I think the forward points are not so high. So
Yes.
do you think it's a good time to hedge longer term, the exposure and investment into China at this point in time, if you think that the dollar uptrend is going to last into 2023?
Correct. So if I'm catching you correctly, you are asking about the durability of the dollar CNY.
Yeah, yes.
More
Or even
durable.
dollar Sing, dollar, yeah, dollar
Yes,
is,
correct.
yeah,
Durability of dollar strength.
Dollar strength, yes,
correct.
dollar strength in
So
general.
if we focus on broad dollar strength, I think there's still scope for the dollar to push a lot more. As in, the market is priced in for 3. But if we get 4 rate hikes or sooner rate hikes, I think there is this trigger on the upside for dollar. And let's not forget that the market has not really digest or factor in the recent rise in yields in dollar. So I think durability, at least I see for this year, I think we are safe to say that dollar is heading higher on a broad basis. And I think in particularly for dollar CNY, we are at the foothills of this upcoming uptrend because we have been dropping, as in the dollar CNY has been dropping the entire, since 2021, the entire year. Yeah, so we are probably, if we catch it correctly, we are just at the foothill. So I mean, you can imagine how far this could go. I mean, if you look at the swings of dollar CNY, this could easily last another 1 to 2 years. I mean, depending on how the economic situation, how monetary policy is being conducted, not only in China, but also in the US. So I think dollar CNY wise, I think the runway is pretty long. I mean, if you ask
So
me.
we are at the foothills of this uptrend, right? And just to drill this in, Peter's forecast for dollar China, dollar CNY is 655
Correct.
by the end of the year, and potentially higher next year. Forecast for dollar Sing at the end of the year is 140,
Yes, 140.
right? So these 2 magic numbers. Victor, attention turns to you. Another scary question for you. No longer about directional interest rates, but basically LIBOR transition. Now, we are nearing the end game for LIBOR transition, right? Middle of 2023, middle of next year, everybody should be out of LIBOR into, and all the old benchmarks into SOFR and SORA. What's your advice to all our clients now in this final stretch of this transition? What should they look out for? Or if I can be more direct, what should they take advantage of now that you know where the end game is? Victor.
So I wish the end game was solved as easily as with a snap of the fingers. Well, I mean, we have come quite a long ways. In fact, we've just crossed a very important milestone. At the end of 2021, the yen, sterling, euro, as well as Swiss franc LIBORs have ceased their publication. And so far, thankfully, we've not received any major reports on major incidences. So that's a good sign, and it's a sign that we take that all the plans and processes that have been put in place is working and is helping us work towards the next major milestone, which will happen at the middle of next year, 2023, which is the cessation of the dollar LIBOR space. I would sort of like to also add, right, that other than all these major milestones, the window of liquidity has really just opened up. And for people looking into transitioning or managing their exposures away from their current LIBORs into the risk-free rates, the relevant risk-free rates, this liquidity is available at a price. However, these transitional markets over time will start to lose their relevance because as exposures being run down, liquidity will also follow. Eventually, these transitional markets will also themselves cease to exist. So the situation here is very much that you do not want to be find yourself in a situation where it is liquidity at any price, right? Now liquidity is available at a price. You don't want to be too late to the game, and you can't find liquidity at any price. So that would be the advice that I'll give.
Okay, so again, if I can be a bit more direct, don't procrastinate. You don't want to wait until all the things are lying in order, but then there's no more liquidity for you to get out of. So just be cognizant of the fact that the old benchmarks liquidity is being run down. So we're coming to the end of this segment. There's still a lot of questions coming, but I think I'll just ask very two direct questions through Peter and Victor. So Vic, maybe it goes to you too. What is your singular strongest view for interest rates this year?
I'll go back to the point that I made about cycles, right? So we have to bear that in mind that we are in a rate rising cycle. And this cycle, as mentioned before, historically has lasted for 2 years. So the trend really is not your friend. So the cost of procrastinating is a lot higher.
So trend is not your friend. Peter, what's your strongest FX view? I need a number from you and a currency.
The number is 655 and the currency is $CNY. I think, like what I've explained earlier, there are strong economic forces, monetary forces at work right now. The last thing I would like to emphasize is even the People's Bank of China is getting a little bit impatient with the strength of the renminbi. So I think it just needs a potential trigger before we see a higher dollar CNY.
Okay, 655 for dollar China. And the next time we do a webinar, I'll ask Peter about follow-up on that. Eileen, closing comments from you, final words of advice to all our customers?
Thank you, Kun Hao. I think I've worked with Kun Hao, Peter, Victor for many years. I think this time around, their conviction is one of the strongest I've heard in the few years that I've worked with them. So I think I like the word do not procrastinate. I think I want to add do not be complacent about your dollar exposure and your rates exposure. Do look into your current existing books to see what you're exposed to in FX and in rates. Engage the sales team early to explore various hedging solutions and make sure you're ready to put on the hedge when the opportunity arises because market is always evolving.
So let me just correct Eileen there, right? Our conviction has been very strong all this while, but it is even stronger this year.
Yes.
Okay, so on that note, ladies and gentlemen, thank you for staying with us this whole afternoon. I've got a lot of questions specifically on specific forecasts, like where is ringgit sing, right? Where is your SIBOR, 3-month SIBOR forecast? Now, please go to the UOB website, UOB Research website, check out our latest quarterly report, and check out that forecast table that has all the quarterly forecasts. Else, make your global market sales rep work. Give them a call, ask them to send you the report, ask them to send you the link. On that note, thank you very much. We wish you a very successful 2022, a very successful year of the tiger to come. I'll hand the time now back to Patricia. Thank you, ladies and gentlemen.
Thank you, everyone, and have a good day ahead. Thank you.